Hi there, Mike Schwartzman, Principal of Develop, back here in our Real Estate Development Basics class. And we are going to get into part 3 now, Proforma analysis and deal structure. I want to again thank everybody on LinkedIn who commented on what you might want to see in this class overview class. And I think this is where we're really going to get into the meat of the matter. So to go through, we're going to look at how we solidify total project costs, building the pro forma operating statement, and calculate investment returns. This is definitely the financial aspect to this overview. When we're looking at our projects, what you really need to do is remember we're in the tenant retention business, and that the process of development is much like a relay race. You're going to have to look how the baton is being passed from one aspect to another. And in my case, it's always been, as a development partner, how am I working with the investment and acquisitions team? What will be my role? And then what will be left to the property management team, who will take care of the building, lease it up, et cetera. So as Steve Covey says, begin with the end in mind. I think that's very important when you're into a development project, and you want to make sure what is going to go on in the end is where you are in the beginning. I used to work for a large company in Washington, D.C. that had a very large development or an acquisitions team and a leasing team. And we would very often have discussions of, oh, well, we're looking at this building, and the leasing team would say, oh, that's great, because if we had new beautiful granite floors and we put in new windows and we spruce up the interior and we redo the elevators, we could get so much money per square foot. But then you get the construction team would get into the project, the budget would be very high. They'd start cutting things to make things work. And they didn't get the fancy floor, they got ceramic tile floor. And the elevator didn't get upgraded with nice wood finishes, maybe it just got plastic laminate finishes. And the bathrooms didn't get these gorgeous partitions and finishes, it got ceramic tile and laminate tops, and everybody would be upset. And I would often say, hey, if everybody sit down at the table to begin with, and we knew what the budget looked like and what was possible and what the rental rate should be, not could be, you might be in a better place. So remember, you're in the tenant retention business. You want to get that final product that gets you to where you want to be financially, or else you're going to be in a world of hurt. I made note earlier when we were looking at the orchestra that marketing, branding, and property management was important. And I want to spend some time here to talk about that, because this is really important with regard to financial results. Marketing, branding companies are very important to a project's success because they are helpful to look at what's going on in the market, who specifically might be your tenant. And again, as I've said many times, and you should be your big takeaway, bring everybody on board day one. Don't wait. There's nobody out there that you don't need to get an idea or an opinion as early as possible from your project team. Marketing, branding, very critical piece in our orchestra, because they might say, hey, your target demographic for this project would be somebody, this fictitious 18-unit building we're looking at here as part of the series might be someone who's 28 to 42 years old. They're working in their career. They're starting to make some money. They might be a rising professional. They also might want a building where they've been working all day. They're working 12, 14 hours a day because they're rising in their company. When they get home, they want something that's hip and relaxed. They want nice finishes. These are some examples of some common areas that might be desirable. We might get into unit finishes where they say, hey, let's look at clean, crisp, comfortable, modern, gorgeous bathrooms, really nice glass showers, nice cabinetry. We'd love to see a beautiful pool. Even with a couple of chairs around it, it still gives you that feeling you live in like a resort style place. Really nice club room with fireplace, seating area, etc. Really nice appliances in the kitchen. Really cool roof deck. Whatever it might be, marketing, branding companies are pretty awesome at showing you what your building wants to be, those aspirations of your future tenant, and how you can start to monetize that. You'll be able to evaluate, hey, working with the architect, the interior designer, the contractor, property management, and marketing branding, you know what? Let's put in some really cool tile in the bathrooms. Let's do something that's a little more non-common or uncommon and make sure things look great. Let's do this, that, or the other with appliances, or what special features we might have. Of course, everything with technology is a big thing today. I think it's becoming pretty common, but everyone's still talking about it like it's the new thing. Property management companies are also extremely helpful, because when you've finalized what your program wants to be, you can then talk to the property management company. If it's, sometimes there are builder, owners, managers, et cetera, all in one silo. I tend to work on projects where owners pull in third-party managers because they just happen to be very good in the jurisdiction that you're working in. May have either a national presence or they're very nimble because they're a local presence, et cetera. So property management team can come in and say, hey, based on your building that you're looking at, we think these buildings are comparable, and these are what the sizes of their unit, these are the sizes, or this is what they're getting for rental rate, et cetera. And they can really help you build your operating statement, because a management company can say, these are what the expenses are going to look like. So they have excellent hands-on market knowledge. They're managing assets throughout the immediate area, the region, the state, country, whatever it is. They're constantly getting feedback from tenants, and they know the trends, they know innovations, they know what looks great, they know what people are complaining about, and they got their finger on everyone's pulse. They know what's hot, they know what's not. And then we're able to say, okay, based on your subject property, and this is just kind of, again, fictitious, we can look at these comparables, and these are what the rent is per square foot and what the effective rent would be per month. Now, while we're in the construction and we're in the trades and we're developers, we're always saying, oh, what's your cost per net rentable square foot? Oh, $3, you're charging what, et cetera, et cetera. Nobody goes into a building and comes and sits down with a potential leasing agent and says, hey, I'm looking to spend $3 a square foot. They're ready to say, I'm looking for a one-bedroom apartment. I can spend $1,800 a month, or $2,000 or $2,200, $4,000, whatever it happens to be. So I'm in Los Angeles. Rents are pretty high here. My last company, I worked from San Francisco to San Diego and other parts of the country. The company before that, I was across the country from the East Coast to the West Coast, and rental rates are across the board. And it seems that, the more downtown urban area you get, the higher the rents go. And sometimes hearing that you could rent an apartment for $8,000, $9,000, $10,000, $12,000 a month is no big deal anymore. It's very possible. You go into New York City, not only could you be spending $12,000 a month, you might be spending it on a closet. So everything's a percentage of people's income. And lately, the cost of housing has been growing as a greater and greater percentage of our income. So we got our subject property. We look at our comps. We look at the various buildings around. We see what kind of finishes they have, what kind of rental rates, what kind of amenities. We start to draw our conclusions about our market. We then can say, if we go back to our example of our project and its building height, what we were going to do, and we looked at our bonus density, and we looked at what we would assume and what we would build in the end, we had to calculate all that stuff. We might have to use different means of figuring all that stuff out, get different consultants involved. Locally, I'm friendly with my friend John Jung, who runs a company called Brick Plus Work. He's actually the one, I have to give him credit, who prompted this class, because it was his friend who was the broker who was looking for more information about real estate development. And because of that, I want to demonstrate that John's firm, Brick Plus Work, when you identify a site, they do that work. They figure out what is by right, what's existing, what's by right, what could be done in development. It shortens the process tremendously. So you can take this kind of information from John's company, go right to the architect and say, hey, we can get a building that's 93 feet tall. We can get this much square footage. These are the maximum dwelling units, et cetera, et cetera. So if you're in a jurisdiction, Chicago, Nashville, wherever, Florida, somewhere, if you can find a company that's like that, or someone who provides that kind of service, that may be very helpful. Otherwise, you're going to work with the team that I described earlier. You're going to figure all this stuff out. So once you do that, then we can really build our building program. And this is the beginning of the Proforma. So we know, for example, that by right, we got a 5,000 square foot site. We got 2 FAR. We can build 10,000 square feet. Let's say we have a building efficiency that's 85%, because you got to consider you have a unit, or you've got an office, or you've got a retail center, a retail shop, et cetera, but you might have some kind of common area. There's something about the thickness of walls, the exterior of the building, outdoor common area, interior hallways, in an office building, the elevators, the common area restrooms, corridors, etc., that limits your gross square footage to your net rentable square footage. So we can look at our height, what we're doing, how many units we would have, and what our gross and net rentable per unit might be. We looked at our bonus density example of how we got some affordable housing, we got some more square footage, we got an extra story, et cetera, and how we look with our affordable units and how we calculate it. To the end of the day, we can then look at parking, which is another component of zoning entitlements, 1 space per bedroom, half a space per affordable bedroom, and not to diminish anybody, but there are different restrictions. And in some cases, jurisdictions presume that some people who live in affordable housing are going to use public transportation, so they reduce parking requirements. I'm now in a circumstance in Los Angeles, there are some areas of the city where you don't need any parking at all, which I think is wonderful, but also crazy, because when I sit down with a management company, our marketing firm, and I say, hey, I'm going to build this building, it's going to have 75 units and we're going to have no parking. Well, that makes a big presumption on the market because you may not be able to rent 1 space without parking. I have 2 daughters, and I want to make sure when they rent a place to live that they're going to have a parking space somewhere secured. So an idea of having a building where they've got to park out on the street at 2 in the morning because they come from a party or they're late coming from some other affair or something. I don't want either of my daughters or my wife, or really my sons or myself, going in some places at 2 in the morning. It's a bit dangerous. So parking's a big concern, of course, with buildings. And then we look at when we've got, let's just say this whole building was 1-bedroom units. 15 market units get us so many parking spaces. Affordable units are at a half, so that's 1.5. Guest space is 3, it's 19. We're gonna have some guest spaces at 1 for every 6 units, so that's 3 spaces. So at the end of the day, after rounding, we've got to produce 20 parking spaces. Now, as we bring everybody on board in the project, the one thing we're trying to do is get everyone's opinion of how much time they need to do their job. And from the due diligence period, the entitlement period, closing, design engineering, permitting, construction, delivery, lease up, close up, et cetera. In this project, in this little fictitious exercise for the small building, I'm thinking it might take 36 months and 3 years. So once we've defined that, what I want to point out is I've shown here where we might do entitlements that take 12 months, but then I'm showing land closing, in that part right at the beginning. So what also could be done sometime with entitlements, if you get involved in a really big job, rather than going out and just buying a site, you may go to an owner who's marketing a site and say, hey, Mr. Owner, I see that you're selling this little strip retail site, and we believe that we could build a 7-story building on that site. And I'm willing to pay for all of the costs for the entitlements and zoning. And I will pay you a certain amount of money day one, and maybe it's going to take a year to do. So every 3 months, I'm going to give you a little more money in an escrow account. But what I want to do is I don't want to close on the land. I don't want to have to absorb, let's say, a couple $1 million in land costs until I know I'm confirmed that I can get my zoning. So that's a very interesting opportunity in most cases. It's how larger firms go ahead and try to minimize dollars out the door to get an owner to take something off the market. They know they're going to get paid, and everybody finds mutual benefit in that kind of scheme. Other owners are like, nope, I want to be out. I want you to pay me today. I don't really care what you want to do. I don't care what it's going to cost. I don't care how much time it takes. I want my money today. I'm moving to Paris. I got other things to do. Now, if we start building our budget, as we've been getting, we took our massing density study, we got opinions of costs and values from everybody, from the professional service providers, the general contractors, et cetera. We can build our budget. So just as one example, here we can look at what entitlements would cost. And again, these are just made up numbers. The developer, zoning attorney, land use, all the players we need, plus application fees, et cetera. This project, I'm saying, would cost $444,000, or about $25,000 a unit. And when I take my costs on each of those individual line items against my schedule, I can then start to produce my funding schedule, which in the case would be all the line items over the entire project. So you can look on a monthly basis of how much something's going to cost, how much equity you have, and how many months the equity pays. And then when the debt kicks in and the lender starts paying, usually during construction, how much they pay every month, et cetera. You can figure out interest rates, whatnot and what. I'm sorry, but pro forma analysis is kind of like when you watch a cooking show and you see the guy making the spice rub, for the roast beef. And he says, yeah, it's got some garlic and onion powder, but it's got some secret things I'm not going to tell you. Unfortunately, this is where I'm not going to tell you my secret sauce, my secret spice rub. It takes a long time to build a big pro forma. I'm trying to give you a lot of free information. Unfortunately, I can't give you a lot of stuff that I consider proprietary, but this is your example. If you take your entitlement costs and you lay them out month by month in a spreadsheet and you figure out who comes in when and when costs go down, you can get your total. You can then check it to make sure you don't have a variance. So you know your total in the spreadsheet and the line items equals your budget. You can then create a full funding schedule from beginning to end. Once we've done that on every different task for this project, I can then show you my total project budget, 7.7, almost $7.8 million. I can look at it where it's a percentage on each one of my line items. I can then look on it as a per unit basis, a gross square foot basis, and net rentable. And that wouldn't make a difference whether it was an office building, I could get the gross square foot, net rentable square foot cost, a retail center, an industrial building. On a hotel, I might look at not only the gross and net rentable square foot cost, but I would look at it on the cost per key or cost per hotel room, etc. So we can establish our total project costs, which is critical for our analysis. And then once we know what we got to do. So in this case, now we can start to determine our capital stack. And in this situation, I want to demonstrate two aspects to this. On the one side, we know we've got $7.7 million, $7.8 million rounded. And I know that I'm going to try to go to a bank and I'm going to get a 60% loan, which would be about $4.7 million, leaving me $3.1 million of equity required. So that's right here. I'm going to get a 60% loan. It's going to give me on the 7.7, it's going to give me 4.6, and then I need 3.1 in equity. I then look at the equity. And let's say this is a situation where there's a sponsor developer who's been working on the project and they've put in some of their money to get things started. As I said, maybe they covered the entitlement phase, but now they need to move to the next. Now the project's going to be real and they're going to go on. And to do that, well, I need some more money. So I'm going to say, I'm going to cover as a general partner. I'm going to be the general partner. I'm going to make decisions. I'm going to be the one in control, moving the project through. And I'm going to get a limited partner who's going to give me 85% of that equity, or $2.6 million. That gives me a 60-40 split. That's 100%. That's kind of shown over here in the capital stack. The bank's at 60% regardless, but then in the equity, I've got 15% by the sponsor and 85% by the limited partner. Yet when I get into it, I'm the sponsor, I'm really only 6% of the total project. The limited partner is only 34% of the total project cost, et cetera. And this is the great way we talked about mezzanine lending. Maybe we got that 60% loan, we got a little bit of mezz financing, that shrinks the amount of equity, and we might still do that 15-85 split, but the numbers go down accordingly. Now, here's the big part about who's in and what position in an equity capital, in a capital stack, especially in the equity capital stack. The general partner whose concept it was, and they're the one running the show, well, if things go south, it's their money that's lost first, because the general partner has to protect the limited partner. So I got to lose all my money, for example, and then protect your investment as a limited partner. And equity always has to protect debt. So the equity would be completely wiped out before the bank would be on the hook. And that's why lenders are in the 60-70% range. They want to know if they buy a job or invest in a job, they are in at 60 cents on the dollar. So they know there's a lot of money to fall apart before they end up with it in their hands. Now, lenders don't want to be in the real estate development business. They want to be in the lending business. Again, they want to use other money to make their own money. They don't want to get their hands dirty. But if it becomes REO, real estate owned by the bank, at the very least, based on the lender's investment analysis, and through investment committee, they can say, hey, we're gonna lend on this $7 million project. We're gonna lend $4.7 million. we're really buying a $7.8 million project for 4.7. So, if it hits the fan, we're going to be protected. We're going to have enough money to finish the job, and we're not going to need much rent to get our money back. And we can sell the project because it's going to be worth $7.8 million. We'll clean up if we have to. They don't want to clean up that mess. Lenders do not want to be in development except by funding things. But that's the way the capital stack works. So let's look at our pro forma analysis. We looked at our building program. We got our net rentable square feet, 11,475. We got 18 units. We've got our average net rentable square feet per unit. We know our different market rate versus affordable. We can establish based on our property manager and our marketing branding company. These are our rental rates, and I recognize 4.68 is a bit ridiculous, almost $5 a square foot. But you know what? Downtown LA for a really sought after building in a great location, maybe opposite from a metro, $5 a square foot for a small unit isn't so crazy. Because remember, keep in mind, the smaller the box, the more you pay for it. So the more you pay on a per square foot basis. As the units get bigger, typically you look at, these are kind of average rents. As you get into a 2-bedroom or maybe a 3-bedroom unit that might be quite substantially larger, the average rent per net rentable square foot might be dropped. Maybe it's only $4 at that point, or $3.95. But we get to our dollars per month. So I look at aggregate. That's always important. Remember, somebody comes in and asks, how much is it per month for me to lease that car from you, or rent this apartment, or rent this office space, not what is it on a square foot basis. So a little under $3,000 a month, or for an affordable unit, under $1,000 a month, basically, about a third. And there are set program indexes based on size of things, and what is the average median income allows you to set what affordable market rents are. And also the affordable unit rates are going to be established by, you're going to work with the jurisdiction. You're going to set up for a program that the city's going to recognize you're putting affordable units in that building. It's going to be for a certain number of years, 30 years, 55 years, 70 years, et cetera. And that establishes various rates. You can also do affordable units that are either at very low income, moderate income, et cetera, all based on average median income of the jurisdiction you're in. And if you go to the jurisdiction's website, they have ample information of how you project those rents. And they're there to work with you. Again, yet another division of the city that would love to talk to you about your project, and would love you, and would love to explain everything you need to know and help you cross the finish line. So here we go. Now, this is our operating statement following stabilization. So we've gone through this entire overview class. We've entitled the property. We've hired all the engineers, architects, interior designers, consultants. We've drawn the building. We've worked with the GC on our budget. We've permitted it. We've built it. And now we're going to lease it. But when we're in that lease up period, that's still kind of part of the development budget, because you'll say, okay, I'm going to lease up this building for so many months, and I'm going to give away a 1 month free, or a 1 week free, or I'm going to give away 1 month of parking space, whatever it happens to be. But when you hit stabilization, when the building is 95% occupied, retail, office, industrial, multifamily, doesn't make a difference. Hotels are different. Hotels are technically vacant every single night. You've rented so many rooms, everybody leaves the next day, your building's technically completely vacant, and everybody makes a commitment for the next day of the week. So that's different. And there are people who specialize in hotels. It's just a different ball of wax. So let's go through where we are here. We've got our market rate units and our affordable units. We know what we're doing per square foot. Let me go up here. We know what the total rent would be, and then we can get on an annual basis, and we can start establishing what our total gross revenue would be. We want to say, just standard bank underwriting terms, we're going to have 5% vacancy. 2% is going to be bad debt. Someone might write a check. Their salary didn't clear the bank when they wrote their check, or they bought something expensive. They went on a holiday. They didn't have enough money. They didn't realize it. Their check bounced, et cetera. There's always a little bit of that. We also would have any kind of concessions. Let's say, as we're leasing up the building ongoing, we're going to give 2 weeks free rent. And that's a certain deduction. But we might have 18 storage units that rent for a little bit, so we get a little bit of income there. And when we add and subtract all those things, we get to effective gross income in year one. We then say, okay, we've got a management fee. That's going to be 4% of our gross income. And then we have various expenses that are both called fixed and variable. So taxes, for example, are fixed. We know what they are. It's based on the value of the building, 1.2%, boom. Insurance, you typically pay a premium, fixed. Repairs and maintenance, well, that might be kind of variable. If not very many people move out, we might not have to do very much. We also might be in a situation where utilities, just maybe we are turning things on and off a little more, less frequently, et cetera. So we work through our expenses, we get the total expenses, and then we get to net operating income. Remember back early in part one, gross revenue, less expenses, NOI. So here's our NOI, and we can take an operating expense ratio. So when we divide the 197 by our effective, we're at basically running this building at 36% operating margin, our operating expense ratio. We can then say to produce our pro forma, which is projecting, it's crystal ball, we're going to say that rents are going to increase by 3%. We're going to still have the same variables and costs that we're going to add or deduct to our gross revenue. We're going to say expenses are going to go up by 2%. Management fee will still be gross, will still be 4% of gross, but we're going to start increasing these expenses by 2%. And you can see that as we do that, our NOI is increasing, our operating expense ratio, because we're increasing rents by 3, but expenses by 2, there's a little arbitrage or spread. Now the operating expense ratio is decreasing. There's your 5-year projected income statement. Now, cash available for distribution. We've worked through the top of this pro forma statement. We got to net operating income and operating expense ratio. Let's say on this building, we had 4.7 million rounded, $4.7 million of debt. Let's say we're able to get that for a 3.5% interest rate with a bank for permanent financing. We're just going to replace the debt. We're not going to try to take equity out of the deal. We're just going to replace what we had. And let's say through that, we have this lender who says, you know what, we're going to give you interest only for the first 2 years, so you can really establish and get your tenants in, really establish the cash flow. And then once we know you're starting to increase your rents and you got your expenses under control, then we're going to want fully amortized. So in year 3, now we're paying principal and interest in a fully amortizing loan. And a fully amortizing loan, technically like a 30-year mortgage on the house, you pay interest, you pay principal, and at the end of the day, after 30 years, you don't owe the bank anything. You've completely paid it off. So we can look then at what those rates that amount would be annually. And we can also look at our DSCR, a debt service coverage ratio, which in the beginning, because we're only paying interest, you can see is very high. The amount of interest we pay divided by our net operating income, the net operating income divided by the amount we pay, we have a 2.11 debt service coverage ratio, very healthy. As we start getting into our AM period, now we're down to 1.48, and it's kind of steady there. 1.25 debt service coverage ratio, the amount of your NOI divided by your annual mortgage payments. Get 1.25 is really the minimum that a bank would do. They want to know that you can afford some hiccups and burps and make sure that should anything go wrong, you can always pay them, because you always have to pay your taxes and you always have to pay your bank. You don't always have to pay, well, you also have to pay utility companies, but maybe your contract services, maybe the landscaper doesn't get paid in a difficult month. So we run that through. We also have capital reserves. If you remember back to part 1, we talked about what it takes to operate a business. So maybe we need $300 per unit and then we get to an annual basis. So we've got some repairs. Maybe the parking lot needs a little repair, maybe a roof repair. We're not going to be caught not ready to roll, or we're going to have the money to pay for that. We've got our rainy day fund. And then that gets you to cash available for distribution. And you can see how it grows and then decreases due to the amortizing loan kick in. That's always very critical, where the mortgage is. Interest only, And you could get a 10-year bullet, interest only 10 years, and then you refinance. You have very low interest, you get a lot of money, but you take risks because at the end of the day, whatever you financed on day one is what you have to finance on year 10. We're going to look at an amortizing loan, and I'll show you that in a couple of seconds. The other thing about real estate that is important, based on the United States tax code, we're allowed to deduct for depreciation. What this says is that the tax law basically recognizes that we own a building that technically is going to dilapidate because of weather condition, wear and tear a little bit every year. And for a residential building, that denominator is 27.5 years. And for a commercial office building, et cetera, it's 39 years. So in this, we can see that we would take the total value of the building, the $7.8 million, divided by 27.5 years is $282,000 and change, almost $283,000. So when we make $176,000 for cash for distribution, that would be taxable, but we take an annual depreciation loss of $282,000, we're actually losing money on paper. We're losing $106,000 per year one, and then it keeps going down as obviously as revenue keeps increasing. But that is the play with real estate and why it's such an attractive investment for investors, because you get losses because of depreciation when the building isn't technically dilapidating. We've got capital reserves, we're keeping pretty good care of it. Matter of fact, it's appreciating in value, it's going up. So that's kind of a bit of the craziness when you hear people say, yeah, I love development, I love owning buildings because I get all the depreciation, I don't pay any taxes. And you're actually getting money. You're making $176,000. You could potentially showing no income. No, you're not going to pay any income tax on it, and your building's appreciating in value. That's why there are many aspects of the real estate business that we feel every time there's a new administration and they think they're going to start working on the tax code, this is the one we're always scared of. Eliminate depreciation, eliminate tax expense, eliminate the 1031 exchange, etc. Now, when we look at these numbers, we can then say to ourselves, what is our yield on total development costs and what is our cash on cash return? So basically, we are making NOI, net operating income, of $345,000. And if you remember, we said that the going in yield, you've been able to establish what a cap rate is on this structure, is that we're making 345, and we know the building was almost 7.8. So if we divide 345 by 7.8, we get a 4.4% yield on total development costs. And if we look at our cash available for distribution, divided by the amount of money we put in the project, we got a 5.7% cash on cash return. And that looks good while we're in the interest period of the mortgage, but then it drops down as we get into the amortization. Now, real estate, everything we do, it all depends on what your taxes happen to be. So I'm trying to demonstrate this, but everybody's different. The most important thing is what's your NOI, what's your yield? So if we've got a project here that has a 4.4% yield on total development costs, well, in the market right now, there are buildings that are traded, existing buildings that are trading for 3% cap rates, 3.5%. I've also heard of things trading recently, really well located, at a 2.85 going in cap rate. So if somebody can buy something on the street for, let's say, a 3% cap rate, but I can build to a 4.4 yield on total development costs or a 4.4 cap rate, I've got 1.4% or 140 basis points spread, which may be enough for my equity investors to say, hey, I'll do that project. I like the math here. I got some real benefit. Now, when a building trades, and you can see we've got our same, what I'm trying to do is show you how this pro forma operating statement builds. So what we're getting to here is year 6. So theoretically, we're going to go through all the steps to develop this building. We're going to build this building. We're going to lease up this building. We're going to operate this building for 5 years. Theoretically, we are then going to say, by the way, a 5-year operating statement is very common in the market. Some people look on 10 years because there's now all these opportunity zones that have different tax implications. When you invest, you get to defer income you would have made, capital gains from a previous investment. You get to defer capital gains you make on the current investment if you stay into it for 10 years and 1 month before you exit. And that's what, is looked to kind of build back some underprivileged neighborhoods, some abandoned communities, et cetera. But in theory, in pro forma analysis, we're going to say on December 31st, the last day of year 5, we're going to sell this building. And then, okay, so if I'm the acquirer of the building, what am I going to base my acquisition on? I'm going to base it on year 6's income statement. So here, the owner of this building is going to show me probably 2 or 3 years of the operating statement. And I'm going to then project. Again, I'm just using those same variables, same amounts. And we're going to say, in year 6, the projected NOI would be $415,000 and change, almost 416 rounded. I'm going to sell this building at a 4% exit cap rate. I'm going to recognize that it's a good market, but my building's now 5 years old, et cetera, et cetera. So we then take, in the formulas we showed, if we take $415,608 divided by a 4% cap rate, that gets us a gross sales proceeds of almost $10.4 million. The $7.8 million building we built and delivered, now 5 years later, presumed on the 6th year, is worth almost $10.4 million. We're going to lose 2% sales costs, commissions, et cetera. We're going to have closing costs. We're going to have basically $10 million, $10.1 million proceeds after expenses. We're going to pay off our loan, but it has been amortizing for a couple years. And we are going to have net sales proceeds of almost $5.7 million. That is $577,000 proceeds per unit. Our costs were $431,932 originally. That means we have $145,310 of net profit per unit, or a 25% profit margin. That should directly answer somebody's question from LinkedIn. So I hope that was beneficial. Now, let's look at that amortization schedule. We are looking at a loan that starts in year 1 for our permanent financing. We are going to have almost $4.7 million. We're going to get this 2 years of interest only little gift from the bank. And then, so we're going to pay interest. There's no principal. So at the end of the period, we basically have the same amount. Boom, boom. But when we get into year 3, not only do we pay our interest, but we going to have amortization. So we're going to have the same amount of interest because of the loan amount's the same. And then we're going to have a portion that's going to pay down the principal as well. And that's going to get us to a lower balance at the end of the period. When we take that into the beginning of year 4, we apply our interest rate on that amount. Plus, we know we have a constant. The constant, when you run the math, either in a spreadsheet or on an HP calculator, if our constant is $251,363 based on our loan terms, et cetera, amortization period, our constant's always got to be the same, which means as our interest rate goes down, as our principal balance goes down, the amount of principal payment goes up to the point where at the end of the day, at the end of year 5, our amortized outstanding balance is about $4.4 million. So we had a $4.6 million loan. We paid down these 3 years of amortization. So we got those principal payments, takes us down to 3.4 or 4.4 million rounded. And then when we looked at that year 6 operating statement, there's our amortized value that I indicated to get us to our net proceeds available for distribution. Now, going back to our formulas that we talked about in section 1. Year 1 NOI divided by total project cost equals your yield on total project cost or your going in cap rate on a development deal. Your cash on cash return is your year 1 equity distribution divided by your total equity investment is your cash on cash return. In this case, that's going to be determined because the equity sponsor, the GP, was in for 15%. The limited partner was in for 85% of the equity. So we do the math for each one of those. And then we look at the total equity multiple. And that is your total distributions, which are those 5 years of operations, plus the sale, divided by our total equity investment equals your equity multiple. And let's see how that looks. So when we looked at our statement, if we put together the fact that we had our year 1 of the project, which was entitlement, year 2 was designing and permit, year 3 was construction, then we had 5 years of operation and we're making money, and we're then going to get sales proceeds. And the amount of those operations, those distributions are based on the GP is getting 15% of it and the LP is getting 85% of it. And that we started, the general partner was in for $466,000 in change. The limited partner was in for $2.6 million in change. When, oops, my bad. Sorry. When we run that math, we look at who put in what money when. In year 3 during construction, no one's putting money in equity because the lender was basically funding that. And then we've recognized cash flows. We can see where we are in total. So we know we have a cash on cash return of 5.7%. Our multiple is basically a 2. That's solid. Your leveraged IRR, that's basically, let me take a second here and talk about IRRs. IRRs are great little analyses done by investment funds, equity funds. It's time value of money. I was trained originally in this business by guys who were 60, 65, 70 years old. They said, you know, hey, if we throw in $10 million, we want $20 million back. We want a 2 multiple. We want to double our money. We recognize it may take 5 years, 6 years, 7 years. That's not the point. The point is, at the end of the day, and look, nobody wants things to go on indefinitely. I can't take $10 million from someone and say, hey, I get you $20 million in 20 years. That's not good. We have to stick to a schedule, because basically what we've been going through in this whole thing about how to do a development deal, it's a business plan. That's basically, you know, when I do an underwriting for somebody, I'm writing a business plan. This is what it's going to take: time, money, etc. So what an IRR is saying here on just the general partner here, if they put out money, 219,000 in year 1, 247,000 year 2, and then they start to make a little bit of cash flow, and then they're going to get a big bump because there's going to be that proceeds from the sale. When you look at this time value on an IRR basis, it's saying over those, what is 8 years, with the money we put money out and the way we want to get money back, it's a 12.5% compounded return. And then your return on your investment, and here's 107%, because we know we got a 2 multiple, we're making money. And then what we can look at in the bottom section, and when I said originally in section 1, we talk about the value of leverage. If we looked at just a non-leveraged deal, all equity, unleveraged return on equity, we would, in this case, we would have to put in all $7.7 million. The equity team would have to pay all the money for the entitlements, the design permitting, and all the construction. There's no lender. It all goes in. At the same time, it all comes out. This is the net operating income, because there is no lender. There's nothing to worry about. Maybe there's a little bit of, you got your NOI, you might account for capital expenditures, but I was trying to make things simple and say, hey, you're going to get all this money every year. And eventually, I keep doing that, sorry. You're going to eventually get your full sales proceeds. And then if you look at those numbers, when you got to put in all the cash, but you get all the returns, you can see your cash on cash is lower, your multiple is lower, your unleveraged IRR is lower than your leverage, your return on investment is only 54%. And again, you can stop this. It'll be, you know, you can look at these things, etc. But that basically works. So we look at what are total distributions, what's the total net gain. You can do the math for the formulas we provided. So if we were to do this, and I apologize, I'm a real estate developer, not very good at technology. If you had done all this, everything we've talked about in these series, you'd be able to prepare your elevator speech for a potential investor. You'd be able to say, hey, I've tied up a site in Los Angeles. I can build a 4-story, 18-unit multifamily building comprised of 15 market rate units and 3 affordable units by implementing bonus density provisions. The proposed building would be 13,500 gross square feet with an average unit size of 750 gross and 638 net rentable square foot. Based on the architect's massing density study and cost estimates from all necessary professionals and general contractors, the total project cost is approximately $7.8 million or $432,000 per unit. The proposed development will take 3 years to deliver, including a year for entitlement, a year for drawings and permit, and a year to construct. Surveying other buildings in the market and projecting rent on market units, I'm at approximately 4.68 per net rentable square feet, or just under $3,000 a month, with a 60% $4.7 million loan to cost on and required equity would be $3.1 million. So once I've got my loan, I need $3.1 million with an 85-15 equity split between the limited partner and general partner. The projected investment return after a 5-year hold period is follows: 4.4 yield on total project costs, 5.7 year one cash on cash return, and a 2.1 equity multiple. I spent some time working in investment bank. I spent a lot of time working with equity investors. I spent a lot of time working with funds. And the idea is that once you've synthesized your business plan, you got to be able to talk very quickly. When you go to New York, for example, or any major investment hub, and you're going to go meet with a number of people, you got to be able to give your speech quick and very detailed. So if you can do all that, that would complete this. I hope you've enjoyed this class. I've certainly enjoyed putting it together and providing all this information to you. I hope that everybody walks away with a lot of new information, maybe some new definitions, some new vocabulary. And quite frankly, when it boils down to, if I've helped one person out there either get excited about development or feel better about what's out there as what you could do in this industry, I think this is the best industry. I don't think you could have any more fun. I know a lot of people enjoy what they do, but I've always enjoyed this. It involves so many different people, so many different aspects. It's so incredible to work with people that know so much about what they do. I hope you find that enjoyment. Have a super day. Thank you. Bye-bye.